Uniform required provisions. NAIC Uniform Individual Accident and Sickness Policy Provisions Law. That last word is important. Each one of these features are required by law. There are, for example, the required provisions of the entire contract clause, meaning if you ever have to go to court, you have to have the application and you have to have the contract so that the judge would be able to compare the two to see where any errors or discrepancies might arise. Time limit on certain defenses. If you see this term on an exam question, remember it has to have something to do with a health product. It is very, very similar to the incontestability clause on life products, but in the health industry, it's referred to as the time limit on certain defenses, usually the first 2 years of a contract. You have a grace period. All policies have a grace period. Thing to remember, grace periods, you have coverage during that time. It's giving you kind of added grace, added time to pay that missed premium. Renewal. Policies have different ways of being renewed. They all have to have some type of renewable feature or non-renewable feature. Reinstatement, meaning if a policy were to lapse, say for example you didn't pay that premium after the grace period, there's nothing left. The policy is then gone. It has lapsed, so you can't apply for reinstatement. Notice of claim. That's basically when an insured notifies the insurance company that they are going to be filing a claim. Usually you're asking for maybe a claim form from the insurance company. Claim forms are what the insurance company would then provide you with in order to give them all the pertinent information that they would need to settle a claim on your behalf. The proof of loss, the actual proof of loss is that completed claim form that you get from the insurer. You complete it and you return it to them for processing. The time payment of claims, there is a certain structure and numbers of days for things to be done in the proper order. You can't wait like years before you were to turn in a claim, for example, and an insurance company can't take an indefinite amount of time to decide if they're going to pay your claim or contest your claim. So we'll talk about that more later. Payment of claims, again, it is the insurance company's contractual obligation to pay a claim as long as it is a valid claim. Physical examinations and autopsies, you might be required to go through some type of physical examination, blood work, things like that, or even more intense depending upon what type of thing you're applying for. And then also in some states, it's allowable for an insurance company to have an autopsy performed, for example, perhaps to determine if you truly did die or pass away due to, say, an accident. Legal actions, of course, you always, if you don't have a claim settled properly or it's taken too long, you always have the option to file, a legal claim. Change of beneficiary. You always, if you're the owner of a policy, remember you control the policy, and one of those things that you control is the beneficiary. Let's talk about renewability clause. Uniform individual there is accident and sickness policy. There's guaranteed renewable. These are and there's non-renewable, meaning it's cancelable, usually attached to change of occupation. So if you have a non-cancelable policy, it cannot be canceled accident and sickness policy provisions law. If you have a renewability clause, there is non-cancelable, there's guaranteed renewable, and there's non-renewable, meaning it's cancelable, usually attached to term policies. So if you have a non-cancelable policy, it cannot be canceled during the period of time that the policy is in place. If you have guaranteed renewable, no cancellation during the policy period, okay? If it's non-renewable, it can be canceled at any time with notice. They can't just call you and say, hey, your coverage is gone. They have to give you X amount of days. Now, premium increases on non-cancelable? Nope, no increases are allowed. What about on guaranteed renewable? Well, the increase on the renewal date, the class basis only, meaning if they're going to raise rates, they can't raise just yours. They would have to raise it for the class that you belong in, maybe male, non-smoker, age 40, something like that. They'd have to raise everybody's, not just yours. Otherwise, that would be discriminatory. And then on the non-renewable, the cancelable policies, those premiums can increase. It'll be based on the type of policy that it's connected to. And then when it comes up to renewal time, the non-cancelable is for the life of the contract, usually to age 65, for example. With guaranteed renewable is for the life of the contract, again, usually to age 65. They do have kind of an end time. When you come down to the non-renewable type policies, the cancelable policies, no renewals are offered. It's only good for whatever the time period of the policy as stated when you first took it out. The insured would have to go purchase new insurance. Think about that. What could that mean to your premium? Probably going to go up because you're going to be older, right? Exactly. That's true. Basic medical insurance. They are limited protection. They don't cover a lot. It was the insurance industry's first attempt to try to come up with some type of medical coverage for customers. So the first one was called a hospital expense policy, and that's exactly what it was. It covered your room and board while you were in the hospital, x-rays, lab fees, and maybe operating rooms. Always covered room and board, but the others, you might have to pay more for, or it just simply might not have covered it. Very limited. Notice it doesn't pay you any of your costs for your doctors and things like that. Just your room and board at the hospital with maybe a few little extras. Next type are medical expense. Therefore, non-surgical stays in the hospital. In-hospital physicians visits, so you're getting a little coverage there if the doctor comes to see you while you're in the hospital. It would cover sometimes maternity benefits, emergency accident coverage, mental disorder, hospice care, home health care, and outpatient care. Again, though, very limited, not covering a whole lot of things. You don't see drug coverages here. You don't see a lot of other coverages that we're used to seeing today. Another one of these types of limited coverages was called surgical expenses. This covered scheduled operations. And when they say schedule, they mean it was literally on a schedule or a list from A to Z. Like you were going to have an appendectomy. You go up to the A's, find appendectomy, and then it would tell you exactly what they would pay for that procedure based on what is usual and customary or reasonable in the area in which you're having that procedure done. That's where that terminology came. All of these types of policies had no deductible, so it was first dollar of coverage, so nothing out of pocket. Major medical insurance. The coverages that major medical insurance provided were comprehensive coverage for hospital expenses, catastrophic medical expenses, and benefits for long-term injury or illness. This is really the first time that you saw long-term illness and injury taken into consideration on any type of health product. Some of the policy features on these major medical insurance policies, they had a blanket limit and also usually a lifetime limit per person, meaning if you had the policy and you had some catastrophic illness and say your limit was $1 million for your lifetime, you reach that $1 million limit, then your policy would be done because contractually they paid you out to that maximum per limit dollar amount. They also included for the first time something called deductibles and coinsurance. Never had those on any other type of medical coverage before, so that comes under the major medical. And they also had large benefit maximums. Again, it was to help cover some of those catastrophic illnesses or injuries or sickness that can happen. The major types of health plans as we know them more today. One is called a health maintenance organization, or HMO. The other is called a preferred provider organization, sometimes referred to as a PPO. Let's take a look a little bit here at HMOs. They are referred to as a service plan. It is a network of physicians that are on salary through the HMO. You can only use an in-network physician in an HMO, or the plan would not pay for an out-of-network doctor. It works on a prepaid basis. You pay a set amount every month. The member selects a PCP, a primary care physician, and you have to run all medical things past that doctor first, even to get a referral to maybe a specialist. All has to go through your primary care physician. Another word for that physician is a gatekeeper. He or she is there watching that gate. They're kind of controlling the costs and making sure that you're not having unneeded things treated and operations that aren't required and things like that. It encourages preventative care. It was the first type of health insurance ever to stress preventative care. Well baby exams, mammographies, smoking cessation plans, things like that. They realized that if we help our clients stay healthy, we're not going to have to pay so many claims. So it was cheaper for the company to start stressing these preventative care routines, and it was better for everybody. Preferred provider organizations, or PPOs. They are also a type of a service plan, like an HMO. They have physicians and hospitals that actually contract with the insurance companies to accept their clients in as patients. They offer a fee-for-service. You pay them for what they do. The primary care physician or referrals that have to go through that primary care physician do not happen in a PPO. So it's kind of one of the major differences between the two. They have what is called in-network or out-of-network providers. If you go to a doctor who is in-network, the insurance company will pay more of the claim and you will pay less. The opposite happens if you go outside the network of doctors. Now, you may be willing to do that, pay more, because you have a favorite physician and you just don't want to give that doctor up. This plan would allow you to keep your favorite physician, but understand if they're not in that network, they haven't contracted with the insurance company, then you're going to pay higher fees and rates to get that care from the doctor who is not in network. Consumer-driven plans. These are maybe some of the newer types of coverages that are out and about these days. There's three major types. There's an FSA, an HRA, and an HSA. We're going to compare and contrast some of the features here. For example, eligibility. Who would be eligible for an FSA? All employees, unless you're self-employed. You cannot take advantage of an FSA. On an HRA, all employees can take advantage. And under an HSA, individuals covered by a high deductible health care plan, they are not also eligible for Medicare. Remember that. Who has to be covered by a health plan? Do you have to take out an FSA? No, you do not. An HRA, do not have to take it out, and neither the HSA. It's totally up to the individual to decide if they want this type of coverage. The contributor on an FSA is usually the employee. Sometimes it's the employer, or sometimes even both are able to contribute. It's just how the plan is set up. The HRA, it is strictly employer only. And on the HSA, it can be the individual or the employer, one or the other. Contribution limits. There are no statutory, meaning state law required limits. Limits may be set by the employer. Under the HRA, there's no statutory limits either, and limits may be set by the employer, also just like the FSA. On the HSA, annually specified limits, regardless of the plan's deductibility. So that's slightly different. Okay, so be aware of that. And carried over funds, meaning you put money into these plans pre-tax during the course of the year. Let's say you're getting to the end of the year and you've got money in your account. What happens? On an FSA, the funds don't carry over to the next year. So it's one of those, you better use it or you will lose it. You want to make sure you spend all the money in that FSA account by the end of the year, or maybe into the first month or so of the next year, depending upon the plan. You have to get your receipts turned in. Now, an HRA, funds do carry over, and on an HSA, the funds carry over also. So remember those differences. The FSA is the only one that doesn't carry over. Limited policies. And when I say limited, I mean really limited. They're usually not super expensive because they have so many restrictions. They're so limited, but they do fill some needs for people. For example, there's something called the cancer or dread disease policy. You go into the hospital, you have a diagnosis of cancer, and you're in the hospital for, say, 20 days. If you had one of these policies, this policy would pay a predetermined dollar amount per day, let's say $100 per day, for every day that you're in the hospital because you have a diagnosis of cancer or whatever dread disease you chose for your policy. And it's over and above any other kind of insurance you might have. And you could have 6 of these policies and they would all pay off. They do not follow the principle of indemnity. Then you have critical illness, which is similar also to these cancer or dread disease. It's for the critical illnesses that can happen to people. You just never know. You're always prepared if you have this type of coverage. Then you have your work site plans. Those usually are what you get as part of your employee benefits. Okay. Then you have the hospital indemnity, which is similar to the cancer or dread disease policy, but it doesn't differentiate as to why you're in the hospital. But if you are in the hospital being treated for several days or weeks, it's going to pay you X dollar amount per day for every day that you're there, that you're hospitalized. Then, of course, dental. I think that's pretty straightforward. You know, your dental coverage for cleanings, fillings, maybe orthodontia, other things like that. Could or could not be covered depending upon the plan. And then vision and hearing. Again, these are usually kind of extra. A lot of times they're added on to employee benefit plans. You could get eyeglasses or contact lenses or hearing tests and maybe even some help with hearing aids, depending upon the policies. They are very limited, but they add some extra nice benefits if needed. The Affordable Care Act. Coverage is available to uninsured individuals who are U.S. citizens, nationals, or legally present in this country. They live in the United States, they are not incarcerated, and they do not have Medicare coverage. The Affordable Care Act, Coverage and Essential Benefits. ACA Plan Features. Guaranteed issue. Insurers must accept all eligible applicants for coverage. No exclusions for pre-existing conditions. Coverage for those denied due to pre-existing conditions are offered through the Affordable Care Act. Coverage for insured's children. Extended to children all the way to age 26. No limits on coverage. Health plans cannot apply limits to essential benefits or benefits paid over the insured's lifetime. The Affordable Care Act Essential Benefits. There are a number of them. Ambulatory or outpatient services, emergency services like the ER, hospitalization, mental health and substance abuse treatment, maternity and newborn care, prescription drugs, rehabilitative services and devices, lab services, preventative and wellness services, and also chronic disease control, and also pediatric services. Metal tiers. The Affordable Care Act has several different plan categories. Each one has the name of a precious metal. For example, the bronze level, the health plan will pay up to 60%, and after the 60%, the participant is paying the balance. The second level is silver. The health plan pays up to 75%, and then the insured pays the balance, or 25%. Under the gold level, the health insurance plan pays up to 80%, and the balance, 20%, is paid by the participant. And on the platinum plan, the plan pays up to 90%, and the 10% left is then paid by the participant. So as you can see, each level from bronze to platinum, the amount paid by the plan is more and then less by the participant. ACA appeals rights. You have internal and external. Let's look at the internal first. They're filed at no cost within 180 days of a claim being denied. The insurer, the insurance company, reviews within 30 days for pre-service claim, 60 days if the insured has received service. The insurer provides written final internal adverse benefit determination if the claim is denied, and the insured gets information on requesting an external review. With external review, filed within 60 days of written final internal adverse benefit determination. Times may vary by state, so be aware of that. May be filed concurrently with an internal appeal if the person's health is at stake. Expedited reviews may be verbal, but written must follow within 48 hours. And these external reviews are considered to be final. Own occupation versus any occupation. If you have a disability income policy and it's an own occupation or own OC policy, as they like to call it, you're going to have better benefits than someone who has an any occupation policy. But understand your premiums will be higher because it's a much more limited policy, and the insurance company is going to most likely have a much larger outlay should you have to file a claim. Whereas if you have an any occupation, they would have less money to have to pay out to you as a disability payment, because even though maybe you can't do your specific occupation, you're still able to go to work and do different duties, maybe desk duties or something like that. Disability income. What exactly is this? It replaces your lost income due to you having been in an accident or becoming too sick to work. Benefits are usually a percentage of whatever your actual income was at the time you became ill or injured. And there are exclusions that do apply, so always be sure to check exclusions because those things are not covered. Disability income policy periods. There's two of them. The first one is called the elimination period. You do not have coverage during the elimination period. You basically notify the company that you have a claim, and then you start that elimination period, that waiting period before your benefits kick in. The longer the elimination period, the longer you wait without benefits, the cheaper the premium, because the insurance company isn't paying you any benefits. So the longer you're willing to accept that total risk yourself, then the lower your premium would be. The other period is called the benefit period. Once you've gotten through the elimination period and the insurance company starts paying you your benefit, the longer the insurance company has to pay the benefit, maybe 2 years instead of 1 year, or 6 months instead of 9 months, something like that. The longer they have to pay you, the more expensive the premium will be. because the insurance company has more out of pocket to pay those claims to you. Remember, there's no benefits for short-term disability, and these things are limited to a specific number of years or usually not longer than age 65. It's going to depend on the type of policy that you have. Disability income. Let's look at the difference between group and individual because there's always going to be some differences. For example, who pays the premium? On group, it's the employer. Sometimes the employees may contribute. It depends on how the plan is structured. If it's an individual policy, of course, you're going to pay the premium on your individual policy. The benefit amounts, they are based usually on a percentage of the worker's income. And on individual, it's just a flat amount of benefit that is determined. Short-term maximum periods on group, usually 13 to 26 weeks is considered short-term. 26 weeks is half of a year, 6 months. And then the individual short-term maximum periods are 6 months to 2 years. So there's a difference there, remember that. And participation requirements. Under the group coverage, minimum number of employees or employees that are eligible, you have to meet those requirements or the plan wouldn't be effective. And they don't apply, those types of participation requirements don't apply on an individual because you're the only one covered on an individual policy. Business disability income. There's basically 3 types. The first one is called key person. It covers the expenses for hiring or training a replacement of a key employee that maybe has become disabled and can no longer work. Also, the business is always the owner of the policy and always the beneficiary. Disability buy-sell. This is a cross-purchase, for example, between business partners. You buy protection against your business partner would buy protection for you. That's how it works. There is a buy-sell agreement. That's the legal document that's drawn up by an attorney. You actually fund it with the insurance products that we talk about. So it specifies how the business will pass between owners. Usually it's a lump sum benefit for the buyout. That's how they work. And then the third type that we talk about is business overhead expense. It pays for rent, utilities, the employee salaries, to keep a small business, for example, open. Maybe for another example, you're a dentist. A lot of times there's just one dentist, and they have a dental hygienist and the office staff. What happens if the dentist is temporarily disabled? He or she has to pay rent, has to take care of their employees. This is the policy that would work for them. It would cover the expense of the rent, the utilities, the employee salaries, while income is not coming in, usually for small businesses. Very useful type of disability insurance. Disability income policies. Basically 3 types: non-contributory, contributory fully, or partially contributory. Let's look at the premium payments on these 3. Under non-contributory, it means the employer pays 100% of the premium. Under fully contributory, it means the employee pays all of the premium. And if it's partially contributory, it means both the employer and employee are going to pay parts of the premium. Under the benefit area, under non-contributory, it is included in the employee's gross income. Under fully contributory, it's not included in the employee's gross income. And under partially contributory, the employer's portion is included in the employee's gross income for any given year. And then the taxation on this follows. Non-contributory, it's taxed as ordinary income. If it's fully contributory, you receive the benefit income tax free. And if it's partially contributory, the employer's portion is taxed as ordinary income. The employee's portion that they pay is tax free. Group health insurance, basic principles. First of all, if you think about group health insurance, one of the first things you have to remember is you cannot get a group of people together just because you want to take out insurance. Say, hey, we're a group, now we're going to get group insurance. Can't do it. It's against the law. There is something called a master policy when you take out a group health policy. The policy is actually between usually the employer or whatever group, is sponsoring the people and the insurance company, and there's that master policy. And then each individual who is covered in that group gets what is called a certificate of insurance. It's usually a one-page document, kind of recaps. It says who's the insured, what's the amount of benefit, if there's beneficiaries, the date of the coverage, things like that. Just a one-page kind of synopsis of what the coverage is for the person. It follows group underwriting rules. Group is always going to have a lower premium cost than individual coverage because they can spread the risk out over that larger group of people, that law of large numbers. They like that a lot. There's two different ways that people can contribute in a plan like this. There's a contributory plan and there is a non-contributory. Non-contributory, for example, means that the employer is going to cover 100% of all of the employees. That is called non-contributory, and 100% have to be covered. Now, if the employees are going to share in the cost of premium, then it's called a contributory plan. And with a contributory plan, at least 75% of all eligible employees have to take the coverage. What do they mean by eligible? Easiest one to remember, usually one of the biggest dividing factors on who can be covered and not is, are you a full-time employee instead of a part-time employee? A lot of times part-timers are not offered this kind of benefit. So for eligible, you would have to, for example, be a full-time employee. And then if